And in our top business story, over 80% of the 4.38 square kilometer Expo 2020 site will be reused or repurposed after the event as part of a wide-ranging legacy plan. Organizers have said that the theme districts, which will play host to most of the country pavilions that are a major part of every expo, will be turned into collaborative workspaces for companies as well as social and cultural institutions. In addition, Dubai World Trade Center will be drafted in to run the Conference and Exhibition Center, which will become a major events venue for the city. The site will also feature residential communities and retail space, with the legacy planners focused on using the site to help develop four industries: education, transport and logistics, travel and tourism, and real estate that are already strategic priorities for the UAE. In a statement, officials said that over 80% of its investments will be retained following the event. This includes the infrastructure as well as the cutting-edge technologies, the roads and public transport systems put in place to host the expo. As the local economy continues to adjust to softening global conditions, overall residential values and rents in Dubai, Sharjah and Abu Dhabi are set for a further decline for the remainder of 2016, according to a leading international real estate consultancy firm. Clutton's 2016 UAE property report shows that redundancies in the oil and gas, finance and banking sectors have negatively impacted demand in the residential property market across the country, with capital value and rental declines likely to be witnessed in Abu Dhabi, Dubai and Sharjah over the remainder of the year. The report's authors stated that there is still some way to go before the bottom of the market is reached, with Abu Dhabi in particular heavily impacted by the performance of oil and gas sector, with further corrections still coming through strongly, particularly at the top of the residential market. Clutton's added that in Dubai, the residential market will start to stabilize by the end of 2017, largely due to the Expo 2020 effect. This in turn should influence the demand for real estate in Sharjah, but until then, further slight softening is expected in Dubai. The firm forecasts that Dubai is likely to see residential values end of the year down by around -5% for apartments and -7% for villas. In Abu Dhabi, Clutton's expects to see villa values end of the year up to 20% lower on 2015 in the city's residential investment zones, while apartment rents are likely to register more moderate falls of 3% to 4%. For Sharjah, rents are expected to end of the year 8% to 10% down on 2015, and the market rebalances.
Definitely there are positive signs about the market. I think we're not quite there in terms of bottoming out, but there are strong signs that things will improve towards middle of next year. Abu Dhabi is a tricky one. It is a bit more reliant on oil and oil and gas sector, oil price. I think that is holding it back slightly in terms of comparison to Dubai and Sharjah. But I think we have seen a kind of subdued market for the last 2 to 3 years now, and there's definitely shoots of recovery that we're seeing some very good value for money in transactional evidence. We're seeing inquiries for new purchases and from new tenants building up. I think location is always very acutely important when it comes to recovery in the market. I think on the residential side, we've seen certain pockets of the market hold up exceptionally well and others suffer a bit more. I think the central locations which have historical success, such as Dubai Marina, Dubai Downtown, some of the usual areas that do hold up well, linked by the metro and very well respected in terms of local amenities and quality of life, are still doing exceptionally well. Also at the more affordable end of the market, we've seen areas like International City hold up extremely well. However, some of the more peripheral locations that struggle, they're still up and coming in terms of amenities and accessibility. We're seeing a price point drop there over the last kind of 12 to 18 months, and we probably think that those will be the slower to recover as we move forward.
Salaries will increase by an average of 4.7% across the GCC in 2017, according to projections from professional services firm Aon Hewitt. The research showed that Saudi Arabia is expected to see the largest salary increase in the region at 4.9%, followed by Kuwait with a projected increase of 4.8%, then Bahrain with 4.7%, Oman and the UAE with 4.6%, and Qatar with 4.5%. Ian Hewitt said that the research is the largest study of its kind across the GCC, surveying 600 multinationals and locally owned conglomerates. The survey found that in 2016, the region saw an average salary increase of 4.3%, down from an anticipated 5% increase for the year based on the previous year's report. Bahrain saw the largest average salary increase in 2016 at 4.8%, followed by Saudi Arabia at 4.6%. The UAE followed with an average increase of 4.4%, followed by Kuwait and Oman with 4.3% and 4.2% respectively. Qatar saw the lowest average salary rise at 3.6%, although the report notes that the outlook for 2017 is significantly higher. Sectors including pharmaceutical, media, and food and beverage saw the highest salary increase across the region last year, while telecoms, construction, and oil and gas saw the lowest. The research added that while 2016 proved to be a challenging period for economic expansion in some markets, policies governing inflation, taxation, diversification, and commodity pricing are expected to come into effect and lead to an upswing in GCC salaries. The UAE's food and beverage sector is growing faster than the demand for its products, according to a survey released today by financial consultancy firm KPMG. The company's F&B report outlined that macroeconomic conditions have created a challenging climate for the sector, with sales stagnating or declining for 64% of the 840 businesses surveyed over the past 12 months. Officials from KPMG stated that the F&B market is growing in the UAE, but the supply of new outlets and concepts outstrips demand. Only a quarter of respondents expected market conditions to improve in the short term. However, all respondents believed that the mid to long-term horizon was positive, with two-thirds of operators looking to expand their numbers of outlets in the UAE, with investment key to harnessing the potential. Some of the key challenges faced by F&B operators are increasing rents, staff turnover, finding good locations for new outlets, and the rising price of food with price-sensitive customers. The survey found that the UAE's consumer demand for F&B offerings remains robust, with the majority of respondents eating out as much as last year and a third of respondents eating out more frequently.